Alright, so before I looked like a homeless guy that lives in Chinatown, I was actually an infantry officer in the United States Army. Another way of saying the military was my former way of life. And as a guy that understands the landscape and industry, I'm pretty bullish on the military companies, and in this video I'm going to be going over 7 military businesses and what prices I think are good for each one of them. So let's go ahead and get into it. Right off the bat, reason number 1 is that war is a necessary evil. As long as there's short, bald men with insecurities that ruffle up feathers for no reason, we're always going to be having to fight one another for the stupidest reasons. History is full of it. Because the alternative is to let the bald evil men do whatever they want, and then humanity as we know it will just be crumbling to the ground. But you and I both know there's always going to be a group of people or a country that is willing to risk it all, sacrifice their own lives, so that other people may be liberated or to be granted freedom from oppression. There's always going to be a group of people that are willing to fight the other folks that are evil. Yes, you might call these people evil, but they're putting an end to the ones that are even more evil. And number 2 is when I think about the military infrastructure, it's absolutely a PP measuring contest. If a country pulls down their pants and whips out a 7-inch Johnson, then the one right next to them is going to want a bigger one and say, hey, mine is actually 7.5 inches. In other words, in the context of military infrastructures, if my neighbor has a big boat, then I'm going to want a big boat. So if China has 100 submarines in their fleet right now, then I want 200 submarines and so forth. Because in the world of military operations and readiness, they're always going to want to one-up one another. When I say they, I'm referring to countries such as the US, Canada, Germany, Japan, China, Russia. It is always going to be a PP measuring contest. And then reason number 3 as to why I'm bullish on the US military companies, well, at least here in the US, the DoD, the Department of Defense budget for the military equipment, arsenal, and weapons, they only increase year over year. That's what the facts and the data tells us. And that's because you will have generals and admirals in the active military that are working on the contracts for these defense companies. They represent the military and do business on behalf of the military while working with, companies such as Lockheed Martin, General Dynamics, that we're going to talk about here in a little bit, and etc. And then when they retire from the military, they transition into a very comfortable C-suite, or at least like a vice president or senior director role with the companies that they just worked with, one of those defense contractors. So what I'm trying to say is that it's in the best interest of the military officers to look out for the military companies and vice versa. They take care of one another. I'm not trying to stand in front of you and say whether that is right or wrong, but if you look at the leadership team for all of the biggest defense contractors out there, almost 95% of them are military veterans that used to hold the ranks of like colonel, a brigadier general, or rear admiral, and etc. It's just the way that the beast and the machine works. In fact, at the time of filming this video, the budget and goals for the year are publicly posted. As it stands right now, the United States, we want more numbers across the board. We want more soldiers and sailors and airmen to be enlisted. We want more planes, more weapons, and etc. And yes, of course, DOGE is slashing funds and budgets for the military, but they're cutting those funds from the DoD civilian employees and contractors. They're not cutting the contracts with the military companies, nor are they reducing the salaries of the military service members. Instead, it's affecting the DoD civilians and employees for the most part, if that makes sense. However, between you and me, I think slashing the budget for Veteran Affairs, the VA office, stupid as hell. I absolutely disagree with that, but that's for another video. And as we think about the landscape of modern warfare, like in the past, maybe like 250 years ago, it was normal to have like all of your soldiers meet all of my soldiers at this digit coordinate on a map and then march towards one another and shoot each other until one of us gives up, i.e. like the Civil War or World War I, like trench warfare. Dude, stupid. It was horrific. Terrible tactics and strategies. However, in 2025, we no longer fight like that. It's no longer a mass wave of infantry soldiers running against another massive wave of infantry soldiers. Rather, in 2025, it's more more so drone strikes. And when I say that, I mean you can unalive someone from 900 miles away in an air-conditioned facility while you fly your little drone and conduct little strikes on perimeters or on FOBs or on units that are across the entire continent from you. And also, I think of carriers and submarines and cyber attacks and cyber defense. I think that's what I think of modern warfare. It's no longer about having the most amount of troops, but rather having the most detailed and sophisticated equipment. And that's why when I think about all the companies that we're going to talk about here today, I try to emphasize that point, as in like, are they up to speed with the landscape of modern warfare? And of course, to a lesser extent, I also think air defense artillery, missiles that can shoot down other missiles that are about to hit your city or country, such as Israel's Iron Dome. I also think that's pretty lucrative and has a bright future. So I think ballistic missiles, but also the defense of those missiles. I'm not trying to say that I'm a war expert, but that's what I think. And to elaborate on my military investing thesis, check out how much each country spends on their military. So this is in 2023. I don't think the numbers have been updated yet, but the United States, they spent $916 billion on the military and the budget and the equipment, the aircraft, the weapons. That's a lot. When you think about our total GDP, that's 3.4%, which when you think about it, isn't that much. In second place is China at $296 billion. And then after them is Russia. I would argue these are the three superpowers in the world right now. India, you could include them into the conversation, but they might be spending $83 billion, but I think their military capabilities, infrastructure, their equipment, nowhere near the US or China. Russia, I don't know, because they're supposed to be the third best military power in the world, and yet they still can't beat Ukraine. So it just goes to show, just because you're spending that much money doesn't mean you're that much more powerful or superior. Tactics are also involved. The equipment that you have is also really important, like how good are they? Are you using aircraft from the Cold War built in 1950? Or are you using state-of-the-art, 2025 stealth bombers? All of that matters and should be a part of the conversation. But something that I do want to call out is, as you look at the next countries, such as like Saudi Arabia, $75 billion, UK, $74 billion, it just gets less and less. Correct? The US, just to remind you one more time, $916 billion. So if we do some quick math, pull up my calculator right here. China, $296 billion, and we add up Russia's 109, and we add up India's 83.6 billion, and let's go ahead and put Saudi Arabia 75.8, and the UK 74.9. So when you add up the next 5 countries, the US still spends more money on their defense budget than the next 5 countries. Let's keep going. Let's see how much more. Let's go ahead and add Germany's. Germany is going to be, what is that? $66.8 billion, pretty respectable. Ukraine, I mean, that makes sense. They're actively at war, $64.8 billion. Still, the next 7 countries together, collectively, still does not outspend the United States in the military budget and spending. Let's go ahead and add France. This will be 8 countries now, 61.3. And no, still not enough. And then Japan. Japan is technically not allowed to have a traditional military. Rather, all of their different military segments, I live here in Japan, are basically defined as like the Coast Guard. Like to protect the country, but not to engage in active or offensive warfare. So they do have like their traditional army. They call it the ground forces. Their air force is called the air defense. Does that make sense? But anyways, they do have a military. Japan's is 50.2. Still does not outspend the US. The next 9 countries together still doesn't. I think if we add in South Korea, who is actually actively at war with North Korea, then I think they're going to beat out the United States. So it takes 10 freaking countries and their spending of their military to beat out the US. Okay, $930 billion. When you put together the next 10 countries, the US alone spends $916 billion. So when we look at the breakdown of military spending in the total addressable market, that's exactly why I picked the US military companies as the winners instead of the ones in Asia or Europe. The United States will continue to spend more and more money on the military than anyone else in the world. It's just a part of our DNA and culture and our way of life. Remember that Borat example earlier? If you have 50 submarines, then we're going to one-up you, and then we're going to have 150 submarines in our fleet. I think as a whole, the United States, we have little man syndrome. We refuse to let anyone else beat us in any category, except when it comes to soccer. Dude, we suck balls. But we're getting better. We're getting better. And just to prove my point, when we jump over and take a look at how much we spend, the United States military spending, defense budget from 1960 all the way to 2025, take a look at this. I would argue during the Cold War, I think it was relatively flat or growing at a very tiny rate. However, as we escalated past the Cold War to the Gulf War, the Balkan War, the invasion of Iraq and Afghanistan and everything, check it out. In 2004, we were spending $493 billion. That's bonkers. And at the height, what is this, the Obama administration? Yes, we were spending $752 billion. And then it kind of went down. However, now we're just increasing it, and now we're at an all-time high. The United States is going to continue this trend of increasing their budget year over year. And the reason why I keep emphasizing that is because defense companies, the military companies, they have contracts in place that guarantee their revenue. Meaning, in other words, if the defense spending is increasing year over year, then the revenue for the military company is also going to increase year over year as they deliver more planes, more tanks, more submarines to the United States military. Does that make sense? I think we all get it. I think at this point, everybody's tits should be jacked because we're now bullish about the US military and the companies thereof. Now let's go ahead and talk about company number one. That is going to be RTX, formerly known as Raytheon. They do a little bit of everything. They do missiles, radar, air defense artillery. Some of their best known products, they have the Patriot missile defense system. That's what the United States Army uses. Think of it as the anti-air and missile defense. They also have the Tomahawk cruise missiles, which is the long-range missiles. They have the Javelin missile. The Javelin is what infantry soldiers use to blow up tanks on the ground. And RTX also has the AIM-120, which is the air-to-air missile that the United States Air Force uses, like what you see on your screen right now. And as we jump over to take a look at their numbers and data, because this is a dividend compounders with cheese video, I can't just be talking about the narrative and the rhetoric. I do like to look at the data as well. On a high level, we're only going to be looking at a few things. Number one, let's go ahead and jump over to their income statement. We do want to see the top line be increasing year over year, because ultimately that's one indicator that a company is growing instead of shrinking or slowly dying. In 2020, they posted $56 billion. And as you fast forward, that's a beautiful picture. Fiscal year 2024, just this past 3 months ago or whatever, for the 12 trailing months, they posted $80.7 billion. RTX. This is amazing. And I do want to emphasize, I know we just alluded to it, but the revenue, when we think about these defense companies, they have contracts in place with the United States government that's pre-approved, meaning their revenue that you see on your screen is guaranteed income. As long as they hold their end of the bargain and deliver the goods that they say they can, for I guess RTX, we're going to give you, I don't know, a box or a pallet full of 100 missiles. And if they deliver that, then they do get paid that money from that contract that was guaranteed to them. When you think about it, the military companies, whether or not you think it's evil or justified or it's good or bad, that's an amazing business model. Can you imagine if Microsoft or Google or Amazon was able to say that, like, hey, for the next year, we can project this is how much money we're going to make in the next 365 days based on the contracts that we have already. Instead, we play it by year. With Microsoft and Texas Roadhouse and Visa, we have to monitor their earnings report every 90 days to figure out, are they on track? Are they on pace to do well? Are they crushing their numbers and expectations? How much money are they generating? When it comes to defense companies, there's contracts in place where we already know how much money they're going to make, as long as they honor their end of the bargain. So the revenue, I think is simply amazing. The next thing we should take a look at is their dividend. Let's go ahead and take a look at this dividend picture. Currently right now, less than 2%, but that's not what I care about. When it comes to defense companies, I think of their dividend profiles as a dividend growth investor. Are they growing it? Are they raising those payouts year over year consistently at a rate that makes my left nipple lactate? I'm a male, but sometimes it does drip a little bit of milk if I see a dividend profile that makes me excited. As we scroll down and take a look at the visual, dude, this is simply amazing. Every 3 months, you used to be paid 40 cents back in 2015, and just look at this progress. My goodness gracious, this is beautiful. Consistently, reliably, and predictably, the dividend payout increases. And remember, the dividend is so much more important than you think. It's the output, the aftermath, and the results of a company that is crushing their financials year over year. Because you can't raise the dividend unless your operations are kicking ass. Because you need free cash flow and net income in order to finance those dividends. So to see RTX be growing their dividend like this, simply amazing. I love it. Good company so far. And one thing that I do want to call out is when it comes to these defense companies, their CapEx and debt levels are usually going to be high because in this industry, they are constantly building tanks, fighter jets, and destroyers and what have you, right? Equipment that the United States military uses, which means they need to have overhead costs in order to sustain factories and production facilities. They need to be continuously maintained and upgraded, and sometimes they even need to build out a brand new shipyard or even open up another factory in order to keep up with the demand. If they just have 2 factories and they just stay with 2 factories, then they're going to be throttled. You can only make so many freaking planes out of 2 factories. So that's why CapEx is going to be high, which means their debt levels are a little higher than usual compared to other industries, but it's nothing to be alarmed about because remember, their revenue model is almost, I say almost, sometimes it can be slashed or cut if they don't hold their end of the bargain. They say, oh, we actually can't deliver this amount of equipment that we promised you because our human capital, we're having issues right now with teaching the new hirees. By the way, that is one company that we're going to be talking about later, Huntington Ingalls. But with that said, I did want to show you their debt to EBITDA is around 3.2, which is not the greatest or the prettiest picture, but it is around that golden ratio of 3 while being a defense company. So I think it's good. Let's go ahead and move on to the next company, and that is going to be Lockheed Martin, ticker symbol LMT. They're mostly known for their fighter jets. I would argue best in class around the world. Their best products, what you see on your screen right now, the F-35, each one of them costs about $100 million out the door. When you think about all of the stuff and accessories that are equipped in it, $100 million. And then they also have the F-22 Raptor, which is a stealth aircraft. Lockheed Martin also has the C-130 Hercules, which is like a transport plane that's huge. In the belly of it, dude, you could fit like hundreds of troops. They also have the Black Hawk helicopter, which we refer to as a bird that's used by the United States Army Aviation. By the way, I've flown in dozens of missions in the UH-60. That thing is pretty darn cool. It's like a roller coaster ride if you've never been in a helicopter. And they also have the THAAD missile system, and they also have some space stuff, which is the Orion spacecraft, and they sell it to NASA. And as we jump over to take a look at their financials on a high level, we're not going to be doing a deep dive, by the way. If you want me to do a deep dive where I spend 40 minutes looking at everything, digging through all of their 10Ks and every single one of their fundamentals and financials, let me know. Because I think every one of these companies, they absolutely deserve the undivided attention. So on a high level, all I care about right now, revenue, is it increasing? This is what we refer to as a top line, by the way, as investors. Is it increasing? $65 billion in 2020. It looks like in 2022 it dropped. That's not good. But since then, they've recovered, and now they're posting $71 billion. To be honest with you, I think the revenue could be a better situation, but what we care about is the trend. Is it going in the right direction over time? Yes, it is. I think during the pandemic, I think they did run into some supply chain issues, and I don't know if it's fair to do, but let's go ahead and give them a pass because I would argue a majority of the S&P 500 companies out there, they were struggling with the supply chain issues during the pandemic. And as we take a look at their dividend profile, I mean, right now it's a 2.7% dividend yield, which I think is kind of juicy. I mean, the minimum standard is 3%, but to have a 2.8%, come on, that's not too bad. What I care about is the growth, right? And once again, beautiful. 2015, you were paid $1.50 every quarter, and since then, just look at the way it has consistently have gone up. This is amazing. Now you can expect about $3.30 every 3 months. Fantastic. That's Lockheed Martin. Now let's go ahead and move on to the next company, and that's going to be General Dynamics, ticker symbol GD. They're in the business of making ground combat vehicles, submarines, and IT services. They kind of do it all. Some of General Dynamics' main products include, number one, the M1 Abrams tank. When we think about armored brigades in the United States Army, like the 1st Cavalry Division, the 1st Armored Division, or the 1st Infantry Division, most of them, they're using Bradleys, but the M1 Abrams, that's the bread and butter for these tank units. They also make the Virginia-class submarines, which are the fast attack ones, but the next generation that has ballistic missiles included into the submarines, they also make that. That's the Columbia-class submarines. And something that I do want to call out is when we think about tanks, I think that style and equipment is quickly being outdated. I think when it was brought out to the battlefield in the World Wars, dude, it was a game changer. When we saw those German tanks, dude, the soldiers were like, how the hell do we beat that? I'm not gonna lie, the German tanks in World War II were superior to that of the US military tanks at the time. Now, I would argue the US military tanks are pound for pound the best. What I'm trying to say is 100 years ago, super relevant and important for battles. However, as we go into 2025 and we talked about the landscape of modern warfare, I just don't think tanks are as important as they used to be. Case in point, as of right now, the United States Marine Corps, we know them as the Navy's infantry, they got rid of all of their tank units, which to me is pretty crazy because I remember when I was going through, the Infantry Officer School in Fort Benning, we were also teaching the Marine Corps officers that were assigned to a tank brigade. However, that is no longer the case. The Marines are now focusing on island hopping warfare in the Pacific front, which makes a ton of sense because the biggest threat to us in the Pacific theater is China. You don't really need tanks when you're going to be operating island to island. The amphibious warfare is going to be super important, so I do see a necessity for the United States Marines and Navy SEALs going forward. Because they are prioritizing their mission set in a different way, less tanks will have a demand and be in use overall. Keep that in mind. Now, as we look at some of their financial guidance, what I do want to call out is when you look at their aerospace division, this past year they posted $11.2 billion, and hey, we were able to deliver 136 aircraft. The next year we're expecting $12.7 billion. It's a pretty modest growth, right? There's nothing to write home about, but it's still pretty good, 11.2 to $12.7 billion. When we take a look at the marine systems, which is the submarines, same exact story, a jump from 14.3 to 15. However, when we take a look at the combat systems, this is their tanks division, it's going from $9 billion to $9.1 billion. Why? Because the demand and procurement of tanks across the United States military is becoming smaller and smaller. However, I don't think this is the end of the world for General Dynamics because they're so diversified, they're making up for it in other segments of their business. So I think that's actually a positive. And as we jump over to take a look at some of their numbers on a high level, let's go ahead and full screen this. I guess right now, what is their 52-week range? They went from about $240 all the way up to $316. $316 was back in November, right before the election, or I think right after. And since then, dude, they've been on a massive sell-off. And actually about 1 month ago, they reached their low, $240. And now they're rebounding, but I still don't think it's a bad time to buy in. Or actually, it could be a terrible time. You got to hold on. At the end of the video, we're going to be talking about that. Let's take a look at their revenue situation. It's going from $37.9 billion to $47 billion. It's going in the right trend. The growth is kind of small during the pandemic, but this past year it went up by 12.8%. So they're doing the right things. I think their aerospace and submarines are making up a huge chunk of that growth figure right there. When we take a look at their dividend profile, 2.2%. Not that juicy, but it's still decent. What we want to see is a picture that looks like this. This is phenomenal. This is beautiful. This shows you the integrity of their financials and fundamentals, especially on their balance sheet, to be able to afford this dividend, to be growing and consistently. And when we take a look at their payout ratio, 44%. absolutely sustainable. And when we take a look at their numbers broken down, let's take a look at it. It looks like the submarines are growing at a double-digit rate since 2023. And also, look at their aerospace. Quarter over quarter, it grew by 30%. So the hypothesis that we talked about earlier of how their tank sales are kind of going down, it's okay because the submarines and their aircraft sales are going up. The next company is Northrop Grumman, ticker symbol NOC. I would argue they do a little bit of everything. They do missiles, drones, and stealth planes. Keyword being drones. Some of their biggest products right now is the B-2 bomber. That's the stealth plane that can't be detected by radar systems and surveillance. However, the United States Air Force is eventually phasing out the B-2 bombers with the B-21 Raiders. That's the next generation of stealth bombers that you really can't see them on a map. When you're trying to survey the skies, that thing can bomb the living heck out of you and you won't even know what hit you. They also have the RQ Global Hawk, which is a surveillance drone, and whether you love it or hate it, they are also the parent company of the ICBMs, the Intercontinental Ballistic Missile Systems, the kind of missiles where you can shoot in the middle of nowhere to the other side of the globe and hit with complete accuracy. However, what I do want to call out is my only concern is that when you think about stealth planes and stealth units in the United States Air Force, there's not many of them, nor is there a need for that much. Unlike fighter jet planes that Lockheed Martin makes, there's hundreds of them throughout the entire fleet of the Air Force and the US Navy, located on their little aircraft carriers. But stealth bombers, it's really situational. What they lack in quantity of sales in their contracts, they make up with through the price tag for each plane they sell. Right now, a B-21 bomber, the average price tag is $760 million out the door price. That is bonkers for one product. That is crazy. As we jump over to take a look at some numbers on a high level, we're not doing a deep dive. Do not grill me for saying, why are you skipping this? Why are you skipping that? Dude, we don't have the time to do that for 7 individual companies. However, if you do want to see one, let me know. As we take a look at their 52-week range, what's going on? It looks like they're bouncing back and forth from like their 52-week low to reaching a high, and then they go back on a sell-off. So if the trend is any indicator, because they just rebounded, who knows? Now they might go back down on a sell-off and hit, what is that? Around 435 again. We don't know. But that's the pattern that we're seeing just from looking at the graph. I did not do the 200-day moving average. I didn't look at their Bollinger Bands or RSI or do any technical analysis, but just looking at it from a high level, that's what I see. They go up, they go down on a very predictable basis. And as we take a look at their financials, their income statement, the revenue, we want to see it be growing consistently. That does not seem to be the case in 2021, but that's during the pandemic. They probably had some supply chain issues and they weren't able to deliver the planes that they promised. But overall, they're going in the right trend, but just not at a pace that would make you feel fuzzy and comfortable. But what about their dividend? Their dividend, the growth rate, 10%, current yield is 1.7. It's okay, but to be decent, I feel like you at least need 2%. To be labeled juicy, that Parmesan, mozzarella, pepper jack cheese, you got to be at least 3%. 1.7%, nothing to write home about, but is it consistent? Yes. It's a beautiful picture. I think what we're seeing is a common theme with the military companies. Their financials and fundamentals are looking so stellar that their dividend profile and the growth rate thereof looks phenomenal. This is so beautiful. Actually, what is their payout ratio? A 29% payout ratio. Absolutely sustainable, and there's a lot more room for growth. So that is Northrop Grumman. Moving on to the next company, that is going to be L3Harris, ticker symbol LHX. They do radio frequency equipment and comm systems like satellites for the intel units, cyber nerds, and radio guys, and a signal for the Army or communications department in the Navy, Air Force, and Space Force. They're also trying to make a name for themselves in the cybersecurity department. In hindsight, on that note of cybersecurity and data analytics and whatnot, I should have included Palantir to this list, but I couldn't. Because as of right now, I think Palantir, solid company, really good financials and fundamentals, but I think they're way too overvalued right now and their trading multiple, too much. The premium is just, I can't justify it, and that's why I didn't include them. But if you were able to pick up shares of Palantir when they were at like $20 or near their IPO at $10 a share, dude, you must be so happy. But to pick up shares of Palantir right now, I don't know if that's the right move. But anyways, as we jump over to take a look at some of their financials, what's their 52-week range looking like? Oh, it looks like they just rebounded from their low. But anyways, about $220. And when we take a look at their revenue, yikes, this is not a pretty picture. It looks like during the pandemic, it was just declining year over year consistently. And then they finally recovered in 2023. And I guess they're in the right trend when you look at it from visually, from the big picture, it's going in the right trend. But I don't know, 5 years ago, 4 years ago, and 3 years ago, not exactly good. So the revenue, I don't know, it's inconsistent. What about their dividend? Their dividend is 2.1% yield. Pretty decent. Payout is 60% sustainable. It's a little higher than the other ones we talked about, but a 60% payout ratio, super healthy, sustainable. Anything less than 79% for a defense contractor, to me, not a problem. The growth rate of 2%, my gosh, that's really small. Wow. But overall, I would say this is a really good, it looks like up until 2022, they were aggressively growing it. But since then, I think they scaled it back, pumped the brakes, and they're drinking some water. They're sipping on that green tea because they're like, dude, our revenue is inconsistent. I don't know if we can keep initiating such aggressive dividend hikes. And so I think the leadership team, they're making a good, tactically sound decision to now, grow the dividend at a very modest rate. But I think this is still really good. I wish they could go back to their glory days of 2016 to 2021 when their financials and fundamentals were kicking ass to the point where they were able to grow their dividend at an absurd rate. But the reality is they are kind of slowing down. So that's L3 Harris, radio frequency and comm systems. The next military company is HEICO, ticker symbol HEI. They do avionics and other aircraft components. So when you think about the electrical control systems and navigation panels, let me simplify it even more. The little buttons and all the switches and gadgets that are in the front of a pilot inside of a plane, that's essentially what they do. And then they send that equipment to Lockheed Martin and the other aerospace players like Boeing. So you can think of it as a parallel play to investing into Lockheed Martin or Boeing, because for them to be successful and for them to deliver their planes, they need the avionics inside that aircraft that the pilots can do monkey press button. If they can't press those buttons, the plane's not going to fly, nor is it going to shoot any missiles. So that's HEICO on a high level. And as we take a look at their, what is going on right here? My goodness, they were on a massive sell-off up until about a month ago, along with all the U.S. military stocks, and now they're rebounding like crazy because of all the tensions that are happening with Russia, Ukraine, China, and Taiwan. By the way, on that note, watch the video that I just made talking about why TSM is moving to the US and it's a strategic business move. Please watch that video to get the full scoop of what is going on with the whole geopolitics and the military around the world. But anyways, as we jump over, take a look at their financials, their revenue, my gosh, this is really small compared to the other ones because they're not selling those $500 million planes. They're selling circuit boards and avionics. And that's why we're seeing revenue figures of like $1.7 billion to what it is now of $3.9 billion. I guess overall it is growing in the right direction. The pandemic, I guess we can give them a free pass. I'm going to go ahead and make the assumption that it was supply chain issues that led to their revenue declining. But overall, I think this is pretty good. It's growing at a pretty aggressive rate, which you would love to see, right? Their dividend profile right now, their dividend yield is a 0.08%. That is hilarious. Why pay a dividend at all at that rate? No, I'm just kidding. I will take any dividend. I'm a whore for dividends. 0.08%, I'll be happy. Just like NVIDIA, they pay a dividend that's literally pennies. I don't even know if it's pennies. I think it adds up to being a penny in one fiscal year. But any dividend is better than no dividend, as I always say. And yeah, it's really pretty. I mean, it's going from 4 cents every quarter. No, it went from 3 cents every quarter to 4 pennies to what it is today. You can expect 11 pennies every quarter. So surprisingly, not bad. But when we take a look at their market cap being $36 billion and their revenue figures being $3.9 billion, pretty small numbers, but Pretty aggressive growth rates, which I think is pretty good. And as we talk about the last company, that is going to be Huntington Ingalls, ticker symbol HII. They are the largest U.S. military shipbuilder for the United States Navy and Coast Guard. Fun fact, 2 of my roommates in college are officers in the Navy right now. One of them is a SWO, a surface warfare officer. I think they're the ones that are in charge of the carriers and the destroyers and whatnot, for the most part, like the overall operations. And the other one is an aviator. And when we think about Huntington Ingalls, their main products include the aircraft carriers. When you think about a boat that's carrying like 50 jet planes, is that it? No, that was a destroyer. That's what an aircraft carrier is. Right there, what you see on your screen right there. It literally is a small U.S. city. It'll have like 3,000 Navy personnel in order to sustain all of the pilots, the cooks, the chefs, the flight crew, the maintenance people. I'm telling you right now, if you have time later today and you're bored, watch any documentary about the United States Navy aircraft carriers. It'll blow your mind. It is basically a tiny U.S. city floating in the ocean. They even have full-size basketball courts. Yeah, I'm telling you, it is absolutely wild. So as of right now, the main aircraft carriers are called the Nimitz. However, they're transitioning to the next generation, and those are called the Gerald R. Ford aircraft carriers. And those, each one, the price tag for that aircraft carrier is going to be $13 billion. My goodness gracious. When you thought that a stealth bomber plane was too expensive, at about $700 million, dude, we're talking about $13 billion per aircraft carrier. Just absolutely bonkers. And they also do submarines, including the Virginia and the Columbia next generation ballistic missile submarines, and they do amphibious assault ships. That's what the Marine Corps and the United States Navy SEALs use. And what I want to say about Huntington Ingalls is this. The United States is separated from Asia, Europe, Africa, and everybody else by 2 big ponds, the Pacific and the Atlantic Ocean. Anyone that has the balls to go to battle with us, they have to sail across the water. But that's where the necessity and growth story of the United States Navy comes into play. If anything, the Navy is America's biggest defensive asset. Because anyone that wants to go to war with us, they need to set up ground and a fleet in the oceans, or they need to make an amphibious landing in Canada or South America to set up an operation so they can invade with their troops, their tanks, their planes, and whatnot. But to be able to do that, you need to sail past the United States Navy destroyers, cruisers, submarines, and that's why when I think about that, my nipples get very bullish towards Huntington Ingalls. And just like the other defensive companies on this list, they have been rebounding in the past few days. However, they are still very far from their glory days of about, what was the 52-week range? Of about $294 a share. Right now, they're $195. I think there's a ton of upside for this company. I'm not saying past performance is indicative of future gains, but I will tell you my intrinsic valuation for this company later on, and it aligns with their financials, fundamentals, and their future contracts that are in place right now. As we look at their financials, their revenue figures, beautiful picture. It's growing year over year. When we take a look at their dividend picture, 2.7% dividend yield. Payout ratio is 39% or just shy of. Please don't be that wise guy who's fat, overweight, hates his life, and comments, "Hey, idiot, it's 38.6%. Dude, are we really going to argue about 39% versus 38.6%? Please sit down, pull your pants back up, do your little comb over to, hide your receding hairline, and just listen to the video, to my relaxing ASMR voice." But anyways, beautiful picture. The dividend is growing year over year, consistently, reliably, and predictably. And do you remember I talked about how there is a company that is struggling right now because their human capital is deficient? Meaning their labor output is not optimized like they used to be in the past. Well, that company is Huntington Ingalls. So during the pandemic, do you remember there was this movement called the Great Resignation, where everybody and anybody across the country, in almost every single industry, from white collar work to blue collar work, people were quitting their jobs? Well, Huntington Ingalls and their shipyards, I think the Newport News one, dude, it got hit so hard. So many of the veterans quit. Meaning they had to do a lot of new hires and onboard a bunch of people who have no idea what the hell they're doing. I think they had like their basic training and their apprentice work, but to become a veteran and like an experienced hand laborer to make a submarine, dude, it takes time. And so that's what's currently biting them in the ass right now. Because all of these new hires are ramping up and getting up to speed, they're still not optimized and creating what they need to create. So when they're able to get up to speed, I think Huntington Ingalls will be okay again. But as of right now, they're not able to honor their promise of saying like, hey, I know we said we're going to give you 100 submarines, but right now we can only do 77 because our new hires, they're not exactly efficient yet. Just give us time. So for me, I think of it as a temporary problem and a buying opportunity because the growing need for submarines and destroyers and cruisers and carriers are only going to increase going forward. And remember, they're the biggest U.S. military shipbuilder for the Navy and the Coast Guard. And their proprietary information and the technology that they have on hand for the submarines and everything, they have a ton of little economic moats in the form of intellectual property. I'm bullish on this company. And as a man of my word, this is how I would rank the defensive companies, ranging from number 1 being the best, all the way down to number 7 being okay. Even though it's okay, it's still a pretty solid investment. Meaning, I would invest into any one of these at the right price. Maybe not HEICO, but at the right price, it would be hard to say no. So for me, I think Lockheed Martin right now is pound for pound the best going forward, especially their future, especially their products, and especially their economic mode. Super bullish on them. And here's the kicker. You would think that I'm invested into Lockheed, right? The way I talk about them? No, I'm not. Out of this entire list, unfortunately, I'm only invested into one. Can you guess which one? It's going to be Huntington Ingalls. Now, if I had pepperoni nipples and I was a fat slob with no morals, I would put them number 1 and I would just say a whole bunch of malicious crap to pump the stock. But I'm not like that. I think, truthfully, out of this entire list, Huntington Ingalls is a solid 3rd place. That doesn't mean they're trash or they're terrible. I still think they're pretty good. However, for the value, for the future, and for the growth, I truly think Lockheed is pound for pound the best. Number 2 would be Northrop Grumman, which, funny enough, I think the buy price for both of the top 1 and top 2 should be around $425 or lower. That's predicated on the premise of getting those companies at a good value investing deal type of buy price, $425. If you believe in them and you want to just buy into it right now, regardless of what price it is, I would just pump the brakes and just be cautious because what you see in the middle column is what price I think this company should be in the next 12 months. So when it comes to Huntington Ingalls, I think right now they're just above 190, but I think their true intrinsic valuation is 250 in the next 12 months. However, I also think if everything goes their way, and they just crush it, I do think Huntington Ingalls could also hit 300. So what you see on the left side is the price that I personally would sell a company at. Meaning, I think they're overvalued, and I think it's a really good time to capitalize on the gains and just sell out of it. However, moving down the list, when we think about RTX, I think a really good price to buy them at is $92. Even up to like $95, $99, solid deal. But anything above like $110, $115, I would hesitate because I think their fair value is $133. And the upside from like 115 to 133, not exactly the greatest. So for me, I would pass. But if it does fall down to like $95, $94, or $93 a share, I think it's a pretty solid deal. General Dynamics, I think their fair price is around $305. However, my personal buy price target is $240. So if they don't reach that number, I'm okay with walking away or just keeping them on the watch list. And then for L3Harris, the radio frequency comm company, I think they're worth about $255. A good buy price, $200. And when we talk about HEICO, I'm not exactly the biggest fan of their business model because they're making the small components and avionics for the jet planes instead of the plane itself. But with that said, I think at the right price, around 185, if they drop down to like 175, I think I might have to start a position in HEICO. Because I think they have the potential to hit 275 if they crush everything. However, their fair valuation in the next 365 days at the time of making this video should be around 230. And if you made it to this point in the video, I have a question for you. What do you think? How would you rank these companies? What's your thoughts and opinions? Do you disagree with me? Do you agree with me? Which ones do you like? Are you a shareholder of any one of them? Let me know. Because I just stood in front of you and talked my ass off for almost an hour, and I sound like a schizophrenic if I don't get any response and communication from the person on the other side of the screen. Regardless of if you're wearing socks or not, pants or not, I would appreciate a reply, good sir And as you type out your response to my small ask, I'm just going to talk about some of the things that are going on in my life. Number one, dude, the Seattle Sounders, the soccer team that I support, dude, it was a belt-to-ass performance against Los Angeles FC, LAFC, 5-2. I'm telling you right now, if you're sleeping on and you don't watch the MLS, the Major League Soccer, which is the highest tier soccer in the United States, dude, you're missing out. I truly think the quality and the entertainment factor is going up. I'm not going to say it's as good as the Bundesliga or the Premier League, but it's getting better and better. And right now is a really good opportunity because the season just started. I think we're in week 3 now. A lot more soccer to play, but if you need a team to support, I'm telling you, just be a bandwagon and just support Lionel Messi's Inter Miami. Their uniforms are pink, but I think their play style is really entertaining, and it would remind you of Barcelona like 8 or 10 years ago. And then number 2, dude, Tottenham Hotspurs just played against Bournemouth. Dude, the worst first half performance. It was atrocious. At this point, I honestly don't know what's going on. I'm not going to hop off being a supporter just because we're going through a rough spot and we suck right now as a team. I'm still going to support them, but dude, it was a difficult watch. Our goalkeeper, Vicario, the Italian goalie, dude, he saved our booties. The real score should have been something like 5-2 in favor of Bournemouth. However, I will say this. What is crazy is once we made the substitutions in the second half, we caught up to them and we were the better team. However, in the first half, dude, Tottenham looked like trash, hot trash, which is weird because historically in the past 2 seasons with Ange, we're always a first half team. We always come out firing on all cylinders and we score the first goal, especially in the first 5 minutes. We're up by like 2-0, 3-0, but now we're kind of a second half team, which is really weird, which means we're having adjustments and good locker room talk during the halftime. But all that to say, at least both of my teams were decent for this week. I mean, of course, I would have loved Tottenham Hotspurs to walk away with 3 points, but I guess I could be happy with 1 point. But on the other hand, my Seattle Sounders, dude, 5-2, you love to see it. And do you remember the other day I told you I'm curious about, I'm like, dude, I think Warhammer looks sick, but it's overwhelming and the universe looks too big. I don't know what to do. So I started to do my research. I narrowed it down to Grey Knights and Space Wolves. What you see on your screen right now is Space Wolves. I think that might have to be my army. You can't tell me right now by looking at that photo that does not look absolutely sick. I think Space Wolves are kind of cool. Anyways, that's all I have for you guys. I love you. Stay safe. Good luck in the stock market. And let me know how you feel about this video. I'll talk to you really soon. Peace.